The Singapore Exchange experienced a major structural rebaselining today as regional macroeconomic shifts intersected with a massive global technology hardware correction. At the opening bell, the Straits Times Index felt immediate downward pressure, dropping as much as 38.5 points, or 0.7%, to trade at the 5,500.83 level. This early morning weakness was driven entirely by global portfolio contagion following a severe tech liquidation overnight on the Nasdaq. However, institutional net buying inside Singapore's defensive banking complex aggressively cushioned the downside. The STI showed tremendous secular resilience, clawing back a significant portion of its early losses to finish the session down just a fraction, comfortably anchoring the broader domestic market amidst volatile international flows. Crucially, retail and institutional data fields confirm that the structural health of the Singapore market remains historically elevated. Aggregate market statistics for the 2026 financial year reveal that securities market turnover has surged by an extraordinary 35% year-over-year to 455.7 billion Singapore dollars. This marks the highest systemic market liquidity seen in Singapore in over 18 years, proving that the exchange's structural initiatives are successfully pulling regional capital back home. The absolute defining headline of the session belongs to a monumental structural policy shift announced by the Singapore Exchange, aimed squarely at democratizing access for retail investors. In an official regulatory filing, SGX announced a sweeping revision to its board lot framework. Starting October 5, the minimum trading lot size for 11 of Singapore's highest-priced blue chips and REITs will be slashed from 100 units down to just 10 units for shares priced between $10 and $100. This policy framework targets the core drivers of local volume, specifically the big three Singapore banks, DBS, OCBC, and UOB. Previously, a single standard lot of DBS shares required over $6,900 in capital, rendering it completely out of reach for the average domestic earner. By lowering the entry barrier tenfold, SGX is aggressively injecting retail liquidity into its primary capital pool. During today's active session, the banking trio displayed mixed, yet highly stable institutional order flows. DBS Group holdings traded under mild tactical profit-taking, sliding 0.31% to settle at $72.67. United Overseas Bank slid 1.08% to close at $43.87, while Overseas Chinese Banking Corporation bucked the downward index trend entirely, advancing 0.39% to settle at $28.75 on robust wealth management accumulation. Moving deeper into the session's corporate lineup, global semiconductor headwinds triggered heavy idiosyncratic liquidations in domestic technology hardware manufacturing. Advanced encapsulation technology manufacturer AEM Holdings faced severe institutional selling pressure, plunging 53 cents to close at $9.32. Portfolio managers aggressively reduced exposure to high-beta technology nodes as global anxieties over hardware capital expenditure cycles mounted. Telecom giant Singtel also experienced minor institutional consolidation, drifting lower by a marginal 2 cents to close at $4.39. This came despite recent corporate reviews highlighting highly stable dividend generation capacities across its core domestic and Australian enterprise segments. Concurrently, the Singapore Real Estate Investment Trust sector, or s-reits, maintained deep pockets of capital resilience. Despite the broader macroeconomic noise, heavyweight vehicles like CapitaLand Integrated Commercial Trust drew steady accumulation. Allocators are actively prioritizing large-scale commercial trusts backed by strong balance sheets, healthy tenant retention metrics, and disciplined capital management frameworks as inflation baselines begin to stabilize. As we look ahead to the next trading week, institutional market strategy demands an absolute focus on key technical boundaries and macro asset shifts. First, track the Straits Times Index at its immediate structural support band near 5,500. A sustained weekly close above this crucial psychological level keeps the medium-term structural bull market intact, setting up a potential retest of its recent all-time highs. Second, portfolio managers must closely analyze institutional net asset flows into the iEdge Singapore Next 50 Index. Data confirms that small and mid-cap securities' daily average value has surged by a staggering 155% in the recent fiscal cycle. This proving that sophisticated capital is aggressively reaching outside the standard benchmark to lock in high-alpha growth opportunities across logistics and engineering sectors. We advise maintaining a highly disciplined, yield-anchored investment stance. Focus on premium large caps that stand to benefit directly from the impending SGX board lot downsizing, while locking in structural dividend hedges within the Tier 1 commercial property trust layer. That concludes the Singapore market update. We will see you at the next opening bell.